For what feels like forever, almost 2 decades really, the US has been the only game in town for investors. It's been the place to be. But after an absolutely incredible run, the winds of global capital, they're starting to shift. So let's dive into why that is.
I mean, think about it. For 16 straight years, US stocks have been on top, leading to this massive, maybe even dangerous, crowding into American markets. But here's the thing about winning streaks, they all come to an end. So the huge question we're tackling today is this: is this the moment? Is the game finally changing for investors around the world?
Well, the early signs are practically screaming at us. Just look at 2025. Emerging markets, or EM, posted an absolutely staggering 33.6% return. That's more than double what the S&P 500 did. Now, this isn't just a little blip on the radar. This is a huge gap. It's a signal that a major trend change might already be happening right under our noses.
Okay, so to really get why all this capital is suddenly looking for a new home, we first have to look at the reigning champion, right? Why is the US market, after all these years of total dominance, suddenly looking, well, a little vulnerable?
The first big red flag is simply the price tag. The S&P 500 is trading at nearly 23 times what it's expected to earn in the future. Now, that's just a fancy way of saying stocks are expensive. How expensive? We're talking near 20-year highs. The market is basically priced for absolute perfection, which leaves zero room for error. Any little disappointment could get punished, and punished severely.
And the second problem? It's what we call extreme concentration. Get this. A whopping 36% of the S&P 500's entire value is tied up in just 10 companies. 10! That means the fate of the entire market is dangerously dependent on just a tiny handful of stocks. It's a massive risk, and a lot of people are taking it without even realizing it. So let's just put the pieces together. The US market is historically expensive, and it's dangerously concentrated. For anyone managing big money, that's a crystal clear signal to start looking elsewhere for growth, for safety, for a better deal. Capital always flows where it's treated best. And right now, that's looking less and less like the United States. Which, of course, brings us to the challenger. As all this capital starts looking for a new home, Asia's popping up as the most logical destination. And it's not just a hunch, it's built on these incredibly powerful structural trends that are pretty much impossible to ignore. So, Asia's rise really stands on 5 core pillars. You've got demographics, a consumer boom, total manufacturing dominance, deep regional trade, and maybe most importantly, a fantastic valuation opportunity. Let's break each one down. First up, demographics. And this number is just mind-blowing. Between 2020 and 2030, 1.5 billion people will join the Asian middle class. Seriously, let that sink in. This isn't just a number. It's the single largest creation of wealth and consumer power in the history of the world. It is going to drive demand for decades. And if you want to see just how wild this shift is, look at this comparison. While Asia adds 1.5 billion new consumers, the Americas, we're adding just 42 million. It's not even close. We're talking 35 times larger. Economic gravity, folks, it has no choice but to follow these numbers. And that demographic explosion directly fuels our second pillar, a consumer supercycle. All those new middle-class families, they're going to want to buy stuff. Cars, phones, vacations, you name it. We're looking at a $12 trillion increase in spending. That's like adding an entire new Chinese economy to global demand. It's huge. Pillar number 3 is manufacturing supremacy. As you can see right here, China's manufacturing output, all by itself, is nearly double that of the United States. And let's be clear, Asia isn't just the world's workshop anymore. It's a high-tech, super efficient factory with an advantage built on decades of investment and sheer scale. This leads us to pillar 4, integration. Over half, 52%, of all Asian trade now happens within Asia. This is such a monumental shift. What it means is the region is building its own self-sufficient economic engine. It's becoming less dependent on us in the West, which makes its growth so much more resilient. And now for the final pillar, valuation. And honestly, this is where it gets really compelling for investors. Asian markets are offering way higher earnings growth and a better dividend yield, all for what basically amounts to a 40% discount compared to the S&P 500. You're getting more growth for a lower price. It's an incredibly attractive setup, especially after these markets have underperformed for so long. So we have all these powerful long-term trends building up. But what's the spark? What's the catalyst that's accelerating this pivot to the east right now? Well, the answer lies in the huge reshuffling of the global order that's happening as we speak.
Ironically, the biggest catalyst has actually been U.S. protectionist policy. Yeah, you heard that right. The whole idea was to bring supply chains and jobs back to America. But the unintended consequence has been the exact opposite. It's actually forcing the rest of the world to build new alliances and deepen its ties with Asia.
And the data doesn't lie. Look at this. While China's direct exports to the US went down, its exports to its neighbors in Southeast Asia surged. At the exact same time, exports from places like Vietnam to the US exploded. The jobs aren't coming home. Production is just shifting around within Asia, making the whole region's supply chain even stronger. And hey, it's not just developing countries. Even traditional US allies in Europe are making a very clear pivot to the east. I mean, with massive trade volumes and key industries like German car makers earning a third or more of their revenue in China, Europe's economic pragmatism is pulling it closer and closer to Asia's growth engine.
So, when you put all of these pieces together, the US market's vulnerabilities, Asia's incredible structural rise, and these huge geopolitical catalysts, a very clear picture of a new world order starts to come into focus. And this quote from our source material just sums it up perfectly. This is not emerging market speculation. This is positioning for the return of economic gravity to its historical center. We're not talking about chasing some hot speculative trend here. This is about a fundamental, multi-decade reordering of the entire global economy. And for anyone out there thinking this sounds completely unprecedented, well, it's not. During the last major cycle like this, from 2003 to 2007, emerging markets delivered a stunning 35% return every year. That's nearly triple what the S&P 500 did. The setup today feels eerily similar, with EM markets breaking out from a base that goes all the way back to 2007. You know what they say, history doesn't repeat, but it sure does rhyme. So here's the bottom line. The evidence for this great rotation of capital is pretty overwhelming. The demographic and economic math is basically undeniable. The only real question left is your portfolio positioned for it?